Hey everyone, it's Mark. I want to talk about something that's been all over the financial headlines lately, and honestly, it's pretty fascinating from my perspective because it involves Meta, it involves where we're investing the company's money, and it involves understanding what's really happening in the market versus what people are perceiving to be happening. There's a big disconnect right now, and I think it's worth unpacking and understanding in detail so you can make your own decisions about what you believe about Meta's future. So let me just cut right to the chase here. Meta stock has taken a significant hit recently. We saw our stock reach an all-time high of around $795 back in August of this year, which was incredible. That was a moment where investors were feeling really confident about our business, about our AI investments, about our future direction. But fast forward just a few months, and we're trading significantly lower down, around $630 to $640 in some trading sessions. That's roughly a 20% decline from our peak, which is substantial. More recently, after our Q3 earnings report, the stock actually plummeted over 11% in a single day. That was our worst trading day in about 3 years. So yeah, people are talking about this. Wall Street is talking about this. Financial news networks are covering it extensively. And they're asking, what the hell is going on with Meta? Why is this happening? Here's the thing though, and this is important to understand, it's not because our business is falling apart. It's not because we're losing users or revenue. Actually, if you look at our Q3 numbers, we absolutely crushed it. We reported $51.2 billion in quarterly revenue, which beat analyst expectations. Our user engagement is through the roof. We have 3.5 billion daily active users across our family of apps. Our artificial intelligence initiatives are working better than we expected. We're seeing strong monetization of our AI advertising tools. So why is the market punishing us? Why are professional investors and hedge funds selling? Why is the sentiment so negative when our underlying business metrics look so strong? The answer is actually pretty straightforward when you understand what's really happening, and that's what I want to break down for you today in detail. Because the market doesn't always react to good news in the way you'd expect. Sometimes it reacts to the future implications of your decisions more than it reacts to your current performance. And right now, that future implication is capital expenditures. CapEx, the massive, unprecedented bet we're making in artificial intelligence, and frankly, the uncertainty around whether that bet is going to pay off. Let me get into the specifics. When we reported earnings in October, revenue was up 26% year over year. That's accelerating growth. Our advertising business was firing on all cylinders. We're seeing AI improvements in targeting, in creative generation, in the entire advertising workflow that's boosting advertiser ROI. This is exactly what we want to see. The AI investments are working. We're monetizing them. This is a success story. But then we made a decision that shocked the market. We raised our capital expenditure guidance for 2025 to somewhere between $70 and $72 billion. Now, to give you context, that's an insane amount of money. We're talking nearly $40 billion more than what we spent in 2024. That's roughly double. That's a 100% increase in CapEx spending in a single year. For a company like Meta, that's unprecedented. That CapEx figure now represents almost 38% of our quarterly sales. Think about that. More than a third of every dollar we bring in as revenue is being reinvested into infrastructure. That's not typical. That's not conservative. That's an aggressive, growth-focused, betting the farm kind of decision. The market looked at that number and basically said, okay, Mark, we're out. We're going to sell Meta stock. They didn't care that we beat earnings. They didn't care that our revenue grew 26% year over year. They looked at the CapEx guidance and they said, this is insane. You're spending too much. This is going to destroy your margins. This is going to destroy your profitability. This is going to destroy shareholder returns. We don't know if this is going to pay off, and we're not comfortable betting on that uncertainty. And here's what makes it even worse for the market sentiment. We're not done. We're not saying this is a one-year thing. We explicitly told the market that 2026 is going to have CapEx spending that's notably larger than 2025. Let me repeat that. 2026 is going to be even bigger than 2025. Analysts are now projecting that we'll spend somewhere in the ballpark of $97 billion on CapEx in 2026. That's another massive increase. So we're talking about 2 consecutive years of $100 billion range infrastructure spending. That's roughly $200 billion over 2 years. That's the kind of money that makes people nervous, and I get it, because that's a lot of capital that's not flowing to the bottom line. That's capital that's not flowing to shareholders as dividends or share buybacks. Now, I want to explain why we're doing this, because it's not reckless. It's strategic, and I want to make sure you understand the logic. We're in what I call an artificial intelligence infrastructure arms race. You've got Google, you've got Microsoft, you've got Amazon, you've got OpenAI and other players. All of the major tech players and AI-focused companies are essentially competing to build out the most advanced compute capacity in the world. Because right now, in 2025, the limiting factor for AI development isn't really code or talent anymore. It's compute. It's the physical infrastructure. It's the data centers. It's the chips. It's the GPUs. It's the networking equipment. It's the power consumption capabilities. When you want to train massive language models, when you want to build frontier AI systems, when you want to serve billions of requests to users with AI-powered features, you need an incredible amount of computational power. And the companies that have the most compute capacity are the ones that are going to win in AI. They're going to be able to train the best models. They're going to be able to deploy the most advanced features. They're going to capture the most market value. They're going to set the agenda for where the industry goes. Google raised their CapEx guidance during the same earnings period we did. They're now expecting to spend between $91 and $93 billion on CapEx in 2025. Microsoft said they expect heightened spending growth this fiscal year. They're being coy about the exact numbers, but it's clear they're increasing CapEx substantially. Amazon's been spending massively on infrastructure for years. They've already built out significant data center capacity. So everyone is in this race, and the implicit threat is that if you don't keep up, you're going to fall behind. You're going to be the company that has inferior infrastructure. You're going to be the company that trains inferior AI models. You're going to lose competitive advantage. What makes our situation a little different is that Meta doesn't have a cloud business like Google does, or like Microsoft does, or like Amazon does. Google has Google Cloud. Microsoft has Azure. Amazon has AWS. These are revenue-generating businesses that provide computing services to external customers. Microsoft and Google can sell compute capacity to outside companies and offset some of the cost. Meta, on the other hand, is building this infrastructure almost entirely for ourselves, for our own AI models, for serving ads more efficiently, for powering our social media platforms, for our metaverse initiatives, for emerging products that we believe are going to be important. So the market is looking at this and asking a fundamental question: is Meta capable of monetizing this infrastructure investment well enough to justify the massive CapEx? Is the return on investment going to be there? And that's where the skepticism comes from. It adds another layer of complexity to the investment thesis. Here's the thing. We're seeing strong signals that our AI investments are working in advertising. In Q3, our ad revenue grew 26% year over year, driven in large part by AI improvements. We've deployed AI ranking systems that have improved ad performance and efficiency. We have AI tools that help advertisers create content, that help with budget allocation, that help with conversion optimization. We're using machine learning to predict which ads are going to resonate with which users. When you give advertisers better tools, they spend more money. They see better return on their ad spend. They come back and spend even more. That's the flywheel effect, and it's working beautifully in our core business. But here's the doubt that lingers in investors' minds. Is this kind of return on investment enough to justify $70 billion in CapEx in a single year? What about the Reality Labs division? Reality Labs, our division focused on virtual reality and augmented reality technologies, has been losing $4 to $5 billion per quarter. We're investing heavily in building out AR glasses, VR headsets, the metaverse infrastructure. We've lost over $69 billion since 2020. That's not a typo. That's $69 billion. And we're still not making any money from that division. Our quarterly revenue from Reality Labs is only around $370 to $400 million, but we're spending $6 billion every quarter. The Ray-Ban smart glasses are selling well, which is encouraging. We've sold millions of them, but we're still in the very early innings of this market. We're not seeing significant revenue from smart glasses yet. It's more of a product that we're developing and getting feedback on. Our Quest VR headsets are selling, but the overall VR market hasn't grown the way many people expected it to. In fact, VR headset shipments dropped significantly year over year in many quarters. What if the CapEx spending doesn't translate into the kind of revenue growth that justifies it? What if competitors build better infrastructure and better AI models with their own CapEx spending? What if we spend all this money and then some other company like OpenAI makes a breakthrough that changes everything? What if the market for AI-generated advertising tools becomes commoditized and the margins compress? What if regulations force us to change how we do AI? These are legitimate questions, and they're the ones keeping institutional investors up at night. They're looking at our guidance and saying, show us the money, show us the ROI, show us that this is going to pay off. I told analysts on the earnings call, the risk for a company like Meta is probably in not being aggressive enough rather than being somewhat too aggressive. We want to make sure we're not underinvesting, and I stand by that. But I also understand why the market is nervous. You're asking investors to basically take it on faith that we know what we're doing, that we're going to build the best AI infrastructure, that we're going to monetize it effectively, and that the returns are going to justify the massive capex. That's a big ask, especially when there are competing ideas about what the best use of that capital would be. Let's talk about the profitability side of this equation, because that's another reason the stock is down. When you're spending $70 billion a year on capex, those are dollars that could otherwise go to shareholders as dividends or buybacks. Beyond that, you're also looking at margin compression. Your operating margins start to come under pressure. Your free cash flow suffers. In Q2 of this year, our free cash flow was $8.55 billion. That's down 12% from the prior year, even though we had revenue growth of 22%. That's the impact of elevated capex spending. You're literally doubling your infrastructure investment while trying to maintain your profitability. The math doesn't always work in your favor, at least not in the near term. When you increase capex by $40 billion, you're reducing free cash flow by a similar amount. That impacts your balance sheet. That impacts your ability to return cash to shareholders. Additionally, we raised our full-year expense guidance for 2025 by $2 billion. So not only is capex going up, but our broader operating expenses are also increasing. We're hiring specialized AI talent. We're paying premium salaries to attract world-class engineers and researchers. When you're competing in an arms race for AI talent, you can't be cheap with your compensation. You need to attract the best minds in the world. We're setting up new offices, building out new teams, expanding infrastructure beyond just the data centers. So when you look at Meta's financial profile in 2025 and into 2026, what you see is a company that's in growth mode, yes, but it's a different kind of growth mode than investors are used to. It's not the kind of growth that flows directly to profitability and shareholder returns. It's the kind of growth that's about positioning for the next decade. It's about building the infrastructure that we believe will power artificial intelligence applications for the next 10 to 20 years. It's about winning the race against Google and Microsoft and Amazon for AI superiority. And that's a multi-year bet where the returns might not materialize for several years. It's a 5 to 10 year thesis, not a 1 to 2 year thesis. Investors, by their nature, tend to be somewhat impatient. They're looking at quarterly earnings. They're looking at forward guidance for the next quarter or two. They're not necessarily thinking 10 years out the way that I'm thinking 10 years out. So there's this fundamental misalignment between what we're trying to accomplish strategically and what the market is rewarding in the near term. There's also another factor at play here, and I think it's worth addressing directly because it's probably affecting investor psychology more than people realize. Some investors are still skeptical about our strategy overall because of the metaverse. Back in 2021 and 2022, we made a major bet on the metaverse. We rebranded ourselves from Facebook to Meta. We started investing tens of billions of dollars into reality labs, virtual reality, augmented reality, building out the infrastructure for what we believe would be the next evolution of the internet. The market was skeptical then, and frankly, it didn't work out the way we hoped it would in the near term. We've lost tens of billions of dollars on reality labs. Some people said we were delusional. Some people said we were wasting money. Some people said Mark's lost it, and he's going all in on a vision that nobody wants. And the stock suffered for it. We went from about $375 in 2021 down to $88 in 2022. That's a 76% decline. So investors have been burned before by our big strategic bets. They've seen us commit massive capital to a vision that didn't pay off as expected in the near term. Now we're saying, okay, we've learned from the metaverse. We're pulling back on that a bit. We're going all in on AI instead. Trust us. We know what we're doing. This time it's different. Is it any surprise that investors are approaching this with some skepticism? They're thinking, Mark said the metaverse was the future. He spent tens of billions on it. Now he's saying AI is the future and we need to spend another $100 billion. Forgive me if I'm a little nervous. They're looking at our Q3 results, which were genuinely strong, and they're saying, yes, Meta is doing well today. But we've seen Mark make big strategic bets before. We've seen them not work out the way he expected. We're not confident enough in this new bet to keep holding the stock. I also want to frame this in terms of competitive dynamics, because from my perspective, this is actually a really important part of the story. We're not the only ones making this bet. Google is spending $91 to $93 billion on CapEx. Microsoft is increasing spending significantly. Amazon has been spending massively on infrastructure for years. So from a competitive standpoint, if Meta pulls back on CapEx while our competitors are accelerating, we're choosing to lose. We're choosing to cede AI leadership to someone else. We're choosing to be the company that invests less in the future. The way I see it, we have three options. Option one, we spend aggressively on infrastructure. We take the short-term stock price pain, but we position ourselves to win in AI over the next decade. We build the infrastructure that allows us to have the most advanced AI models. We build the infrastructure that allows us to serve users with the best AI-powered features. We build the infrastructure that allows us to compete with any company in the world on AI. Option two, we don't spend aggressively. We protect near-term profitability and shareholder returns, but we risk falling behind in AI and losing relevance to competitors. We risk being relegated to second-tier status in the AI race. Option three, there's some middle ground where we try to optimize spending and find a balance between near-term profitability and long-term positioning. But in an arms race, you either keep up or you fall behind. We've chosen option one. I believe that's the right choice. I believe that AI is going to be the dominant technology of the next decade, and I believe that if you're not investing aggressively in AI infrastructure, you're making a mistake. Some shareholders and investors agree with that perspective, others don't. And that disagreement is being reflected in the stock price. Another factor weighing on Meta's stock that I think is important to discuss is regulatory uncertainty. We're dealing with increasing regulatory pressure in the United States and especially in Europe. Data privacy regulations, content moderation policies, antitrust investigations. These are all things that could materially impact our business. The EU has already fined us hundreds of millions of dollars on various regulatory issues. There's ongoing investigations into whether Meta has too much market power, whether we're engaging in anti-competitive behavior. Any one of these regulatory cases could result in massive fines, forced divestitures, restrictions on how we operate our business. When there's that kind of uncertainty hanging over your head, investors get nervous. They look at your massive CapEx plans and they start to worry about downside risks that they might not have considered before. What if regulators force us to divest Instagram or WhatsApp? What if they impose usage restrictions on our platforms? What if they impose restrictions on how we use data for advertising? How would that impact the ROI on all this infrastructure investment? I'm not saying these things are going to happen. I'm saying that in the minds of investors, these are non-zero risk scenarios, and they're factoring that into their valuation models. It adds another layer of uncertainty to an already uncertain situation. Regulatory risk is real, and it's particularly acute for Meta given our size and our presence in multiple countries. So to wrap this up, why is Meta stock crashing? It's not because our business is broken. It's not because we're losing users or revenue. It's not because we're failing to execute. It's because we're making a massive multi-year bet on artificial intelligence infrastructure, and the market is uncertain whether that bet is going to pay off. Our stock is being valued not on where we are today, but on where we're going to be in 3 to 5 years, and that's creating a lot of uncertainty and skepticism. Is the market right to be skeptical? Maybe. Are we potentially over-investing in infrastructure? Possibly. But I genuinely believe that this is the right move for Meta. I believe that AI is the future. I believe that infrastructure is the foundation of AI. I believe that Meta is positioned to win if we execute on this strategy. The companies that build the best infrastructure are going to be the companies that dominate AI. The stock will ultimately be determined by execution. If we execute well, if our AI investments drive strong revenue growth, and if we eventually see margin expansion and operating leverage, then the stock will recover and go much higher. If we don't execute well, if advertising weakens, if our AI products don't resonate with users, if we waste capital on infrastructure we don't need, then the market will have been right to be skeptical. That's the bet. That's why the stock is down. That's the story. We're betting on artificial intelligence. We're betting that it's going to be transformative, and we're betting that Meta is positioned to win. Time will tell whether we're right. But from my perspective, the risk of not investing is greater than the risk of investing too much.